Hola, muy buenos días. Les habla Carles Gaju, gerente de distribución institucional, y en nombre de BICE Inversiones les doy la bienvenida a nuestro webinar de hoy. Hoy nos acompaña Francis Rodiloso, Head of Fixed Income de BANEC. Él estará a cargo de la exposición de hoy que hemos llamado BANEC Falling Angels, elevándose alto, donde presentará acerca de la metodología y desempeño de las estrategias de Falling Angels en BANEC. Como siempre, al final de la exposición tendremos tiempo para conversar con Francis, por lo que no duden en ir dejando sus preguntas en el chat. Son preguntas privadas y después las iremos revisando, agrupando y realizando al final de la presentación. Welcome, Francis. Thank you for being with us today. You have our full attention. Please go ahead.
Thank you very much, Carlos, and thank you for joining. I'm going to share a screen so that I can talk to some slides about fallen angels, which are our topic today. And 2021 has been another, actually quite an interesting year for fallen angel bonds. Give a little bit of historical perspective. Fallen angels have outperformed broad high yield significantly over the last 18 years. And out of the last 17 complete calendar years, fallen angel bonds have outperformed 13 of those 17 years through all parts of the credit cycle. It is certainly the case that we are getting quickly to later stages of the credit cycle already after quite a spread widening and mini credit crisis in the early part of 2020. Years like that happen to be historically the best years for fallen angels, but certainly not the only years where fallen angel bonds have performed well and also better than broad high yield. What we're looking at now is just a chart of where spreads are, and we can see they are tight historically, not at the tightest levels they've ever been, which goes back to pre-global financial crisis in 2007, but they are near their tighter levels over the last 5 to 10 years for both broad high yield, for fallen angels, which is a blue line, and for investment grade credit as well. So yes, there is less risk priced into credit markets, but we'll discuss that a little bit later, what that has meant for fallen angels in terms of performance relative to broad high yield. As I said, 2021 has been interesting because after we saw record volumes of new fallen angels last year, we've only seen a handful of new fallen angels this year. But we've continued to see really strong outperformance by fallen angel index versus broad high yield indexes and versus a variety of broad high yield indexes. And some of that outperformance has been driven by differentiated sector allocation. So you could see the chart on the right is showing that a fallen angel index, the ICE Bank of America Merrill Lynch Fallen Angel Index, is overweight in energy, consumer goods, and automotive versus broad high yield. So the chart on the left shows energy and consumer goods are two of the biggest sectors of outperformance relative to broad high yield. And that makes sense. The more cyclically sensitive sectors were the biggest underperformers last year. Fallen angel index added to those sectors as bonds were downgraded to high yield. And those sectors have been the better performers as the globe has been awash in liquidity and there has been rapid economic recovery in 2021, although it has not been even, of course. But maybe I'll back up for a minute and just talk about a couple of basics about fallen angels. First of all, just to review for some investors who might not be as familiar, fallen angels are high yield bonds that were originally issued as investment grade bonds, as opposed to new high yield issues from borrowers that are used to borrowing at very high rates. Because the issuers were originally investment grade, or because the bonds were issued when the issuers were investment grade borrowers, they tend to have different characteristics versus broad high yield, both at the individual bond level, the individual issuer level, but also at the portfolio level or at an index level. And there are three key reasons why the Fallen Angel Index has outperformed broad high yield over time. And it has a lot to do with these different characteristics. But first of all, though, there's just a technical aspect, and this has been critical. When bonds are transitioning from the investment grade universe to the broad high yield universe, there are simply more sellers than buyers. The investment grade universe is far larger in terms of assets under management. By virtue of the fact that these issuers are being downgraded, they are either out of favor credits, certainly declining credits, either for increasing leverage too much through acquisitions, or declining margins, perhaps loss of market share. They could even be in declining sectors or industries. But the fact is, historically, regardless of the reason for the downgrade, the vast majority of fallen angel bonds have become undervalued due to the fact that there are fewer buyers willing to take on those bonds as they enter the high yield universe. And an index that adds these bonds monthly during the month which they've been downgraded is able to really take advantage of that value. A couple of other aspects, though, at the index level of fallen angels versus broad high yield. One is fallen angel index will tend to be much higher credit quality on average. And that's because most fallen angel bonds actually stay in the BB category. Over the last 10 years, for instance, the ICE, Bank of America, Merrill Lynch fallen angel indexes have stayed between about 70 and 95% in the BB category, broad BB minus, BB, or BB plus. The broad high yield indexes have typically been, for the last 10 years, below 50% in BBs, although with all the new fallen angels last year, they're slightly above 50% today, whereas fallen angel index is around 94% in the BB category today. Because fallen angel bonds are coming from the investment grade universe during periods of either a sector distress or overall credit stress, or it could be just on an idiosyncratic basis, the sector weightings in the fallen angel index might not be representative of the new issuance trends in the broad high yield universe, which means there could be very different sector exposures, as we showed a couple of slides ago. And that's important to note, because really what that's led to is when there's a lot of new issuance in a hot sector, fallen angel index is not adding to that sector, but that's when spreads are usually tightest for a given sector. Fallen angel index really is contrarian, adds to a sector when that sector is in decline and when there are many, many downgrades. And again, over time, each of these sort of different characteristics versus broad high yield have contributed at various points in the credit cycle to better performance among fallen angels versus broad high yield. A couple of other things to note. Yes, a fallen angel index, because its original issue investment grade, and the bonds are issued in the investment grade universe are often issued beyond 10 years to maturity versus high yield, which are usually issued 10 years and in. Fallen angel index will have higher duration. It will also, because of the higher credit quality, usually have a lower yield than the broad high yield index. Yet, as we'll look at later, fallen angels have actually again, outperformed consistently, even in years with rising rates. So with a lower carry cushion and higher duration, fallen angels, because of different sector and quality differences and the effect of new fallen angels and sometimes rising stars, have still outperformed even in rising rate environments. But we'll touch on that a little bit more later. This is just by way of review. we talked about the overselling that happens when a bond is downgraded to high yield from investment grade. This chart just shows the average price performance of a fallen angel bond from 6 months before it enters the fallen angel index through 6 months after it has entered a fallen angel index. And this just proves out the statement about forced selling or more sellers than buyers. You can see the bonds have tended to lose about 8% in price terms over the 6 months prior to their downgrade to high yield and their entry into the ICE BAML Fallen Angel Index. And they've recovered, amazingly, most of that price loss in the ensuing 6 months after index entry. So this is really, one of the key drivers of outperformance, certainly the technical effect of fallen angel bonds being oversold. Basically, you're buying still quality bonds within the high yield universe, double B bonds, but at valuation levels that represent true value or cheapness. And it would not be surprising then that the years where there have been the highest volume of new fallen angels, or the most opportunities to buy bonds cheaply, those have also been the years where the outperformance versus broad high yield has been the greatest. So the gray line on this chart refers to the left to the right-hand scale, which is the new volume of new fallen angels in a given year. You could see 2020 had about $160 billion worth of new fallen angels. The blue line is just showing the return differential between fallen angels and broad high yield. And you could see 2020 was one of the years of a peak in outperformance, as was 2016, 2012 and 13, and 2009. As well as 2006. And you can see those peaks are either the same year or the year following, often a couple of years following, for a couple of years following the peak in fallen angel volume. So certainly that technical effect is an important driver of returns, but not the only one. There have only been 4 or 5 peaks in terms of fallen angel volumes, yet we've seen outperformance of the fallen angel index 13 out of 17 years. More to the question of, 2020, there was such a huge volume of fallen angels. In 2021, it's been very little. But, what's the prospects for more fallen angels? One thing to keep in mind is that with, help from, the Fed, the central bank of the U.S., central banks really globally, markets have remained awash in liquidity, and new issuance volumes have been very heavy since mid-2020, and the investment grade universe in the U.S. continues to expand very, very rapidly, to the degree that the triple B minus universe is now nearly $1.2 trillion. It's not that far away from the size of the entire high yield universe. So there's $1.2 trillion dollars worth of bonds that are a couple, 1, 2, or 3 downgrades away from becoming high yield bonds. So even on an idiosyncratic basis, we could still see years, mid credit cycle, where 50, 100, 150 billion of bonds are downgraded to fallen angels, which would be on an historic basis very high fallen angel volumes. Today, or most recently, I think this was end of June numbers. This chart has a lot of information on the chart at the top, but if you look at the very last row, triple B minus and 1 rating action away from high yield, so only 1 more downgrade needed to get to high yield, because the ICE BAML high yield fallen angel high yield index uses an average rating. So you just need the average rating among either 1, 2, or 3 ratings agencies to fall below investment grade for those bonds to become fallen angels. Only about 25 billion was at that level, as of the end of June. We've already seen actually a couple of billion of new fallen angels over the last month, however, And if you look at how many issues are 2 or 3 rating moves away, that number expands quite rapidly. Should the credit cycle turn, should economic growth disappoint over the next quarter, 2 or 3 quarters, you will see a lot more bonds. The number could quickly rise to 100+ billion in terms of one rating action away or negative watch or outlook. So we think the universe will continue to see new opportunities, maybe not at the level of 2020. We actually hope not. But we think that contributor, the new fallen angel contributor, will continue to play a role in fallen angel performance, but it won't be the only factor driving performance. And I'll talk more about the other couple of factors, sector and quality, as we go forward. Here are some of the bonds that have been downgraded. These were what were downgraded during the first half of 2021. They represent only a little over 1% of the index. There have been a couple of more downgrades over the last month, and again, we anticipate continued. In fact, Nordstrom, the retailer, was just downgraded to high yield about a week and a half ago, and will be a new fallen angel entrant at the end of this month, or should be into the index. So I said I'd talk a little bit more about the other differentiating factors of fallen angels versus broad high yield, and so we'll start with the quality aspect. As I mentioned earlier, about 94% of the fallen angel index today is rated in the BB category. As a byproduct of that, you can see about 1% is rated CCC or below, much lower distress ratio than the broad high yield universe, which today is about 55% BB. That's the chart on the right, and about 11% rated CCC and below. Interestingly, in fact, I think I have a chart on it. I may skip forward to address that now. This year, CCCs have actually been the best performing component of the high yield universe. The chart on the right is showing year-to-date performance for each of the credit categories. The orange or brownish orange line is CCC and below. And by the way, the darker blue line are fallen angels. So fallen angels have outperformed all other parts of the broad high yield universe, except the CCC and below. What's interesting is even with almost no CCC and below exposure versus 11% in the broad high yield universe, fallen angels have actually still outperformed, as we've mentioned several times, broad high yield by a significant amount this year. Broad high yield is the dashed gray line on this chart on the right. And by the way, if you look at the chart on the left, which goes back to the inception of the ICE Fallen Angel Index, you could see that fallen angels, even over long periods of time, outperform the riskiest part of high yield. So CCC and below, with great volatility, outperforms other parts of broad high yield over long periods. But fallen angels, again, outperform CCCs over long periods of time with much less volatility and with a completely different risk profile, as we can see again here. Again, 90. And what does that mean? I mean, well, one, when there's a credit, let's say when the credit cycle turns, when there's a downturn in the credit cycle and spreads are widening, a higher BB component could lead to a buffer against that spread widening. So lower spread volatility. So that can help outperformance in a down market. Now, if the sector makeup of fallen angels is unfavorable, it may not outperform in a down market. That did happen once during the life of the index in 2018, but in most down markets, fallen angels have outperformed broad high yield, and the quality components played an important role. Another important factor are rising stars, or bonds that get upgraded from high yield to investment grade. And fallen angel indexes have had a lot higher ratio of rising stars, about 5% annually, more than 2 percentage points above the broad high yield market. Bonds, we'll look at a little bit more about rising stars in a few minutes. Those bonds do tend to outperform into that upgrade back to investment grade. And so a higher rising star ratio can help lead to outperformance. By the way, another important factor is just on average lower historical default rates by having a higher BB component, a lower CCC and below component. Almost ironically, fallen angels had a higher default rate than broad high yield last year, yet very significant outperformance, just like in 2009. And that is because default rates on an issuer account may have been high, but the fallen angel index turnover was so high last year. Over 2/3 of the portfolio were fallen angels that occurred last year, and so it stands to reason that default rates will rise during the same year that there are many downgrades from investment grade to high yield, and so the technical component, the idea of picking up a bunch of cheap fallen angel bonds, far outweighs the negative impact of defaults during years like 2009 and 2020. But over long run, fallen angels have averaged lower default rate. You can see the numbers on the right. The blue 1.95% is the average annual default rate for fallen angels. So that's been over long periods of time a contributor to a positive relative performance versus broad high yield as well. So that's one aspect of quality. Lower average annual default rates. I talked about a buffer during periods of spread widening with higher BB, lower single B and CCC exposure. But I also did mention potential rising stars. And so you said the broad fallen angel index averages about 5% in rising stars annually. But a year like 2021, we anticipate we could see by the end of the year a higher level than that, even potentially significantly higher level. In fact, you can look at the bars on the right in terms of percent of market value. What percent of the index for fallen angels, which is in the blue bars, or for broad high yield on the gray bars, what percent of the index are potential rising stars? And if we look, upgraded to IG year to date, those are the lowest bars on the far left, just about 1.5% or so for fallen angels, and almost nothing as on a percent of index for broad high yield. Rated BB plus and only one notch away from investment grade, over 15% of the fallen angel index today has that characteristic, whereas just over 5% of the broad high yield, closer to 6% of broad high yield. If you move all the way to the right, you could see 3 ratings actions away, you're at 25% for the fallen angel index and still around 6 or 7% for broad high yield. Why does that matter? How significant is the performance of rising stars? Well, if you could have just a few percent higher rising star ratio, that's meaningful over time, but 5 or 10% could mean a lot. Here are 3 rising star examples historically. This Ford, which is a fallen angel again, by the way, but had been downgraded during the mid 2000s and was upgraded again in 2012. Over the 12 months into its upgrade, Ford outperformed the broad high yield market on a price basis alone by about 15%, a 10% price gain for Ford versus a 5% price decline for broad high yield overall over that 12 months. We had a decent sized rising star early this year in Synovus, which is one of the energy credits downgraded during 2020. In fact, we were only showing a 9-month chart for Synovus because that's how long it spent in the fallen angel index. it actually had a close to 50% price gain over those 9 months, whereas broad high yield had about an 18% price gain. So, Synovus was the best performing part of the Fallen Angel Index last year. But you can see how rising stars, or bonds that are upgraded to investment grade from high yield, can greatly outperform broad high yield. And by the way, we had one at the end of August, ArcelorMittal, which was a bit of a volatile credit over the last 12 months, but still outperformed broad high yield by more than about 2 or 3%, more than 2% on a price basis over the 12 months leading up to its upgrade. So there's a wide range of performance. Ford 15%, Synovus by 20 to 30%, and ArcelorMittal by a few percent. But on average, what we've seen are rising stars over the 12 months prior to their upgrade outperform broad high yield by about 8% on a price basis. So this chart is showing the average price performance of rising stars in the Fallen Angel Index over the 12 months into their index exit, which is the month end after which they're upgraded, versus a 1% loss on a price basis on average for broad high yield over those same 12-month periods. So that's why rising stars matter, and that's another important part of the Fallen Angel story. The higher BB component, a lot of companies that really do have an incentive to get back to investment grade. They built their financing plans around being investment grade issuers. They managed to lose that status. And many of them have a great desire and many incentives to return to IG. So it's an important component of the Fallen Angel Index. Well, we've seen credit spreads tighten, as we saw earlier. Are all these potential upgrades priced in? If you look at the chart on the left on a sector by sector basis, the majority of bonds in most sectors are still trading wide. The majority of bonds that are already rated BB plus in the Fallen Angel Index, they're still trading at wide spreads to their BBB minus comparables. So that's the lowest notch of investment grade BBB minus. So there is cushion. There are some issuers that are trading below their BBB minus comparables. But on a relative basis, BB plus versus BBB minus, this chart on the right shows somewhere sort of around mid-range, and so on an issuer by issuer basis overall, we still see room for compression in most cases of spread or outperformance should there be additional rising stars. This chart just shows that 2.6% or so rising stars had occurred through the end of June in the index. And, you can see Synovus, I mentioned, was 2.25% of the index when it came out. ArcelorMittal, I mentioned, came out the end of August. So this chart had not been updated. That was another 1.3%. So getting close to 4% year to date in rising stars, but we think there's potential for a much higher number. I meant, again, there are three sort of components: the technical effect of fallen angels, selling off, representing attractive value, the importance of the quality aspect of the Fallen Angel Index, and then I mentioned, the sector differentiation. So I just wanted to cover that quickly. Those are the three pillars of Fallen Angel outperformance relative to broad high yield. This chart is just showing the Fallen Angel sector allocations with the blue bars versus broad high yield in gray. And as we saw earlier, energy, consumer goods, and automotives are the three significant overweights. Healthcare, media, services, and financial services are the four significant sector underweights. These are not active decisions by the index. It's just the fact that it adds to the sectors where there are the most Fallen Angel bonds. The index captures, all the fallen angels that had qualified for ICE's investment grade indexes, and this is how it has played out. These sector allocations changed dramatically in 2020. Energy increased by about 15%. Consumer goods were virtually zero at the beginning of 2020. Automotives was at zero at the beginning of 2020. So this is a very, very dynamic index. And the sector allocations can become more concentrated. As you can see, energy is still around 27, 28%, having peaked at 30% last year. But that's not unique. And this chart is showing the full history of the ICE Fallen Angel Index. And you can see that automotives, at one point in the early 2000s had reached almost 40%. Banks touched almost 30% back in 2012-13, having been almost zero before the global financial crisis. Energy hit almost 30% back in 2016, and then again last year. You can see automotives pop back up to 10% last year with the addition of Ford. What's really interesting, though, is that if you look at the charts below, the two rows of numbers on top are the fallen angel annual returns, and below are the broad high yield annual returns. Outperformance tends to follow the addition of these sector concentrations, or greater outperformance, and that performance has traditionally been driven by those very sectors. So just going hand in hand with being a contrarian strategy, GM and Ford and their financing companies got downgraded in 2004, 2005, very out of favor. They become heavyweights in fallen angels and start outperforming. Same with banks, especially sort of some subordinated bank debt after the GFC, and then again after the European financial crisis in 2012. You see, banks became the biggest weight in the index, by 2012, and then really drove out performance for 2 to 3 years. So, and energy, by the way, drove out performance from 2015 through the end of 2019. So the sector concentrations have worked. Also, by the way, being underweight sectors has worked quite well. Fallen Angel Index was underweight energy in mid-2014 at less than 5%, when the broad high yield index was closer to 18% energy. And so did not start adding to energy in a significant way until oil prices really started bottoming out in late 2015, and actually added a bunch of energy names right at the very bottom in February of 2016. So sector differentiation has been an important factor. So all three of these factors, sector differentiation, quality, and the fallen angel technical effect, all play a role no matter what part of the credit cycle we're in, or at least they have historically. And so this chart is just showing sort of how the credit cycle flows from expansion to peak to contraction to trough. And you could imagine spreads would be the mirror image of that curve that we're looking at. We sort of rank what has driven relative performance at various parts of the credit cycle in that middle section here. So during expansion and peak part, which really we've been in over the last say, well, really 15 months now. Sector differentiation, the fallen angel technical effect, during the expansion part. And now that we've hit more of the peak, or getting closer to the peak of the credit cycle, we're seeing lower impact from new fallen angels, as they tend not to happen during the peak part of the cycle. They'll tend to happen during the contraction, and a whole lot will happen after the trough. So higher quality has really been the other key part this year, with more rising stars, and we anticipate when the credit cycle does turn and we see contraction, that quality, acting as that buffer, as we discussed earlier, will be really a key driver of relative performance. And that's, we know we're later in the credit cycle. This has been a very rapidly moving credit cycle this time. And a lot of people say, well, fallen angels, last year was a year to own them. As I've mentioned several times, though, no, fallen angels have outperformed 13 out of 17 calendar years. They have outperformed by a greater margin when spreads have widened right after the credit cycle has hit rock bottom, and there are a bunch of downgrades, which tend to be lagging indicators. And the fallen angel technical effect could really drive meaningful outperformance. But the areas in white on this chart are actually, the numbers are given for them on the numerical chart below. Those are periods where credit spreads are actually below average. So the sort of teal blue line here is just showing the option adjusted spread on broad high yield. When that line's below average, that's when we're in sort of the expansion to peak period in the credit cycle. During all 5 of the periods since the launch of the Fallen Angel Index, where we've been below average or in that expansion and peak period, fallen angels have actually outperformed broad high yield. Not by the 5 to 10 percentage points that they can during those really big years of high fallen angel volumes, but meaningfully, except for the first period where it was almost a dead heat, 2003 to 2007. But if you see the other periods, 2010-11, 2012 to 15, 2016 to 2020, and most recently July of last year through the end of June of this year, and the outperformance has continued now through early September. You can see, again, fallen angels have outperformed through the credit cycle. And it might not be the high fallen angel volumes that are driving outperformance during these periods. It's more about sector allocations and quality. One last chart, and maybe we'll open it up for questions. And this is just, again, a year by year bar chart of performance of fallen angels and broad high yield. This chart is highlighting some years where either Fed funds have, the Fed has been tightening, so rate hikes in the U.S., which would be sort of near a cyclical peak in credit, are also a couple of periods where we've seen yields out the curve move significantly. 2009 and 2013, the only 2 years where 5-year yields moved more than 100 basis points higher. Interestingly, you can see in those years and most of the years of Fed tightening that fallen angels outperform. So even during years of higher rates. I'm going to pause there. Maybe we can take some questions. Maybe I'll leave the presentation up unless my friends at BICE think we should take it down.
I think it's good, Frank. Maybe you can leave it there. Thank you very much for your presentation. Frank, we have a couple of questions, and you mentioned before how important is the rising star within the Fallen Angel Index. So a quick question regarding when they exit, when they do, sorry. So the point of the rising star is very important. So how they deal with the index, please?
Yeah, no, really good question. So rising stars are bonds, as we mentioned, that get upgraded, or their average rating becomes BBB- or higher. So their average rating becomes investment grade. They will exit the index at the month end during which that upgrade occurs. That brings their average rating to investment grade. So a bond that, if today is September 9th, a bond that's upgraded to an average rating of BBB- today would exit the index on September 30th of this month. So it's very systematic, but much like fallen angels, which enter the index on the last day of the month during which their average rating falls below investment grade, this timing has seemed to work really well. In other words, the market tends to be ahead of the ratings agencies. So a lot of the price improvement has occurred by the time that upgrade happens.
Thank you, Francis. Maybe using the figure that you are presenting right away, I mean, this slide 23, the question is regarding the taper tantrum in 2013, sorry. How did this fallen angel index did on the broad, compared with the broad index of high yield? And later, if you can give us some examples. I mean, you have another slide where you present some examples of some year within the cycle of the you know the falling strategy. So if you can try to give it looking ahead, how is 2022 facing, or what type of example you think might be similar? So if you can combine these two questions, please.
Yeah, sure. No, I think it's, I did put this slide up because I think it's a valid question. The fallen angel index has been running 2.5 to 3 years longer duration than broad high yield, and duration difference does it usually grow during the years of new volumes of fallen angels, because a lot of new bonds issued beyond 10 years fall into the fallen angel index. Going back to the first part of the question, the taper tantrum, you could see that was during the calendar year 2013, really. For that year, fallen angels returned about 9.25% versus about 7.4% for broad high yield. So both did well during the course of that year, but with some pretty heavy volatility, particularly into September of that year when yields peaked. By the way, just good way to lead into the second part of the question. Between the end of 2012 and early September of 2013, almost the same week in 2013, 5-year yields rose from 72 basis points, 0.72% to 1.8%. 10-year yields rose from 1.75% to 3%. That was a big move. In fact, something we could imagine happening should growth start reaccelerating, if the world can maybe now in a surprising way get past some of the COVID variants, and we see more upward growth surprises rather than downward revisions. Maybe we'd see a reacceleration of rates. But it's interesting to note that both high yield overall, but did okay during that period, but fallen angels outperformed. Into September that year, by the way, fallen angels were still up 3.85% versus 2.7% for broad high yield. By the way, investment grade. So if you went super safe from a credit perspective during the taper tantrum, on broad investment grade, you were down 4.5% through early September. You got back a few percent into year end, but investment grade still finished the year down. So high yield was still a good place to be with that rate volatility in 2013 because the carry helped absorb some of the treasury losses. Fallen angels, even with a longer duration, were even a better place to be than broad high yield. So other factors, the sector allocation in particular, was a big factor in relative performance of fallen angels versus broad high yield this year. Those rate moves are interesting. 5-year yields this week, I don't know where they are exactly this morning, but they're a little over 0.8%. A couple of days ago, 10-year yields were in the high 130s. So not too far off from where they were at the end of 2012, heading into the taper tantrum. And again, on a year-to-date basis, fallen angels have outperformed. Remember, we might have seen rates come back down a little bit over the last few months, but 5-year yields are still 45 basis points higher than where they ended the year and where they ended 2020. 10-year yields are still about also 45 basis points higher than where they've ended 2020. So we've already seen rates rise this year. We've seen them come back down, but net we're in a rising rate environment. Fallen angels outperformed broad high yield by 2.4%. Broad investment grade is slightly down on the year, so the duration there has been a bigger factor. The lower carry there has been been a bigger factor. Going into next year, so we think, you know, there's still enough spread, although spreads are tight, and in a credit contraction, you know, there's risk of poor performance for high yield in general. We think fallen angels could do better in that environment because one, of the higher quality, and two, they would see a lot more new fallen angel opportunities. In an economic expansionary environment where rates start rising, that probably is a better credit fundamentals environment. So maybe we wouldn't see as many fallen angels, but we think, you know, in that scenario, we still think the higher carry and high yield is enough to help mitigate some of the price loss from interest rate moves. And we think the higher rising star occurrences could play a pretty important role then in fallen angel versus broad high yield performance over the next 6 to 12 months. Hope that addressed the questions.
Sure, Francis. Thank you very much. You mentioned during the presentation how important is the pricing issue, because I mean, fallen angels are investment grade bonds that, I mean, have they lost their those type of classification, and there are few buyers there. So few buyers are demanding the price. But how competitive is this market? Are prices for this type of bonds that outperform the other alternatives are increasing those prices? Are less or more buyers? Because one of the key, the highlight points you mentioned and pointed out is the point that the few guys buy in this type of fund. So how competitive is that market?
Yeah, so the chart I showed earlier, I think I brought it back up here, just sort of the price loss 6 months into, over the 6 months into that downgrade to high yield, and T0, that middle of the chart there that's highlighted, that's the point of index entry. I've seen a lot more written about fallen angels the last few years, particularly after 2016, when the performance was really, really good versus broad high yield, after, you know, a bunch of energy credits that, you know, were highly out of favor, you know, became heavyweights in fallen angel indexes and led out performance. Also some mining issuers. So even early last year, you know, we got a lot of the same questions about, you know, are too many people paying attention now? Will all these bonds just get scooped up? Before last year, the price loss on average had been about 7%. So we actually saw heavier price losses last year on that brought the overall average for the life of the index down. I think more people are paying attention, but you know, I think what happens is, you know, these are periods where someone is looking at a credit, seeing it being downgraded for reasons, often in a sector that's quite out of favor, unless you know, someone is being as systematic as an index. They, you know, I think sometimes human emotion or simple rational thought comes in and says, whoa, I want to wait and see what happens. I want to wait and see how this plays out. So we didn't see effectively this get arbed out. You can see what the index you know, did last year in terms of outperformance versus broad high yield. So there seems to be still not wild competition in the market for buying these bonds, even if there are more buyers overall. One thing to remember also is the growth of investment grade ETFs means there are some natural sellers right at month end for a lot of these bonds as well, which, you know, which helps the high yield index. High yield indexes, you know, add them at the very same time.
Thank you, Francis. I think from the audience, we don't have more questions. So first of all, I want to thank you, Francis, for being with us this morning, and hopefully we have an interesting conversation for the audience, and obviously for all our BICE clients. We are delighted to have you here this morning, and thank you very much, Francis, for sharing with us this morning. Para toda la audiencia, muchas gracias por habernos acompañado esta mañana. Espero que haya sido de su utilidad. Esperamos prontamente volvernos a encontrar y quedamos desde ya a su disposición para entregarle más antecedentes de esto y las reuniones one-on-one que sean necesarias. El equipo está a su disposición. Así que, having said that, thank you very much, guys, for being there. And Francis, see you soon, hopefully. And be safe, eh?
Thank you again, and thank you, everyone.
Thank you, guys. Bye.